Hi, I'm Jarrad Brown, Australian expat financial planner based here in Singapore. Welcome to my video series where we tackle some of the tough personal finance questions for Aussies all over the world. Today what I'd like to share with you is all the information, all the key information about withholding tax, what you need to know, when it applies, what the tax rate is. We're going to cut through some of the myths out there as well, and how you can factor this into your financial planning. So first things first, what is withholding tax? Now, withholding tax is the amount of tax automatically withheld for you by the financial institution. Now, that might be a bank or a share registry, and passed on to the Australian Tax Office for you. Now, when does that apply? That will apply on any bank interest that you earn in Australia, any unfranked dividends that you receive. Now, partial franking can also attract some withholding tax. Unfranked or franking means how much tax did the company already pay before distributing that dividend to you. So unfranked means that the company didn't already pay tax and you're therefore receiving that unfranked dividend, and therefore withholding tax applies. Now, it will also apply on royalties. So if you own farmland or you own a mine in Australia, not going to apply to most Aussie expats, I know, but just so you're aware that it does also apply to royalties. So let's have a look at what the rates of withholding tax that actually apply are. Now, the rate of withholding tax that applies is 10% on any bank interest or royalties that you receive. So by that I mean if you receive 2% in bank interest, which is probably a bit of a dream at the moment given where cash rates are sitting, then 0.2% of that interest would be withheld by the bank, by the financial institution, and paid to the ATO as withholding tax. So 0.2 being 10% of the 2 that you received. Now, on any unfranked dividends that you receive, the rate of withholding tax is 30%, subject to the double tax agreement between where you reside and Australia. Now, this is very important because if there's a double tax agreement in place, like there is between Singapore and Australia, then that withholding tax rate on unfranked dividends reduces from 30% down to 15%. So quite a bit of a saving if there is a double tax agreement in place. It doesn't mean that you should invest all of your money in dividend paying stocks or avoid unfranked dividends, but let's have a look at what you might want to think about when it comes to factoring in withholding tax and your financial planning. Now, first things first, before we get into what you want to consider with your investment strategy and your financial plans, is to point out that if you don't have taxable Australian property, i.e. investment property, farmland, mines, etc., then you probably don't need to be filing a tax return. Now, ask your accountant about this one. There may be a reason you should, but if all you've got is cash in the bank, earning interest, or you're receiving dividends from shares, then just because there's withholding tax, that's automatically held, paid to the ATO for you. It doesn't mean that you definitely need to file and submit a tax return in Australia. Now, what should you think about when it comes to your financial plans? Well, if we've got withholding tax on interest being applied, then naturally we should think about where we hold our cash. Now, very important here, make sure you're comparing apples with apples. Just because you've got 10% withholding tax on cash in the bank in Australia doesn't mean you should automatically move that money offshore. It may be sitting in an offset account in Australia, which is generating a higher rate of return because it's offsetting interest. There may also be currency risk by moving that money out of Australia into Singapore, for example. So make sure you do your homework here, consider where you're holding cash, and make sure that you're comparing like for like. Similar sort of story when it comes to our shares, our investments. Naturally, for Australian expats, a lot of us are going to want to accumulate our wealth in Australian dollars to minimise that FX exposure. So again, consider where you're holding your equities. Are you invested in Australian shares that are paying unfranked dividends? What portion of your portfolio pays unfranked dividends? You may even want to think about, if you do hold Australian superannuation, that you take advantage of franking credits within your superannuation fund, because your super is still an Australian tax resident. So you can still get those franking credit benefits. We're not going to go into all of the ins and outs in this video, We've got other material you can check out on that one, but just to cover off the basics. So think about what you're holding. Again, as I said earlier, it's not a reason to avoid any unfranked dividend paying companies because they still could be a great investment. But again, a little bit like the cash, make sure you're comparing apples and apples. Make sure you're factoring in that 15% withholding tax on unfranked dividends. If you're in a country, residing in a country where there is no double tax agreement in Australia, then as I said, that rate jumps to 30%. So make sure you do your homework here, consider where you're accumulating wealth, don't ignore the withholding tax, and make sure that you factor it into your overall financial plans. I hope that's been helpful. I hope that shed a bit of light on withholding tax, dispelled some of the myths and the noise out there around the need to file tax returns or avoid assets because of tax applying. Don't forget to subscribe, hit the notifications. Really appreciate you tuning in, and I look forward to seeing you next time.